Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. As always, this is not investment advice, it's just for educational purposes only. Today, I'm going to be looking at an article that I wrote at the end of last week on PNC Financial. I think I wrote this right after they reported earnings. So they reported in the morning on Friday, and then I think I had this out by Friday afternoon, which is very fast for me, but with so much going on with banks, and this is one I've covered quite a bit in the past and been right on quite a bit in the past. So I wanted to kind of get that out there. The headlines, we'll just start off with with a big pet peeve that I have about the way that Wall Street works when it comes to the news and retail investors especially, which is who this is really geared toward. The headline was the PNC beats by 34 cents, okay, for the quarterly earnings report. Technically, that is true, which we'll get into, but I'm going to explain why it's really not true. But first, I'll run through kind of my history with PNC. I don't think I've ever made a YouTube video because I bought this one in March of 2020, right at the bottom on the 23rd of March 2020. And I didn't start making YouTube videos really until the beginning of 2021. I made a bunch of them. And then I kind of took a break and I'm coming back now with more regular videos, so I never really, I don't think I ever really made a video on this one. But I didn't know when I bought this that was going to be the bottom of the market. I actually probably would have expected the market to keep falling on that day that it bottomed. And honestly, I didn't really want to buy it. I was not feeling really good about banks at the time, that we might have been heading into like a depression. But I knew they were cheap if anything good happened, basically within like 3 to 5 years. And so I kind of set a limit of maybe 5 or so banks and 10 or so broader financial stocks, which had sold off more and were cheaper at the time. And I said, well, I'll buy that many and then I won't buy any more. And we'll just take our chances. And if things don't work out, then at least I kind of limited my losses a little bit. As it turned out, almost all these banks returned like over 100%. PNC was no exception. So let's see here. So I bought it. Then I was trying to see what this chart was. Oh, I actually I warned on this stock way back in 2018, and that's what this initial chart was. I forgot I even had written about it. I've added a different type of analysis since 2018 that I was using with that article, but it was a warning article, like a sell article, where I was talking about how much PNC stock could fall if we had a recession and if we were near the top of the cycle back in January. I think I wrote it a little bit after January in May 9th, 2018. So I warned on it then, and the stock actually did fall more than 40% since then, and it actually underperformed the S&P 500 consistently since that article. So that ended up being a good warning article. And then when it got down here, then I actually stepped in and bought it. But I was using a slightly different strategy that I'll get into here, which I've made videos on in the past, but just not specifically on PNC. So the thing is, let's get down here a little bit. And then I sold it, which I wrote an article on that, pretty much right at the top. It doesn't always work out that way, but I made 176% return in a little less than 2 years, outperformed the S&P 500. And then since I sold it, the stock price has fallen another 40%. So this doesn't happen with every stock, but this is one that I've really just managed to nail a top, a bottom, a top again, and now we're maybe looking to buy at another bottom. So that's kind of what this article is about. So yeah, that's my history with the stock. So I've done pretty darn good, okay? This this particular earnings report, here's my beef with the beat. If you look back at, since I've written on this a few times the past few quarters, just 6 months ago, okay, analysts were expecting $6.57 a share of earnings for 2023. So this isn't like a long time ago. It's just a little over, it's 2 earnings reports ago. And in between that time, before this last earnings report came out, analysts were expecting $14.60 per share, using the averages that FastGraph uses. If you use Seeking Alpha's average, it was a little less than that. I think they were looking at, let's see, did I publish that? I wrote it in here somewhere. It was like maybe maybe I put it up here. They were looking at 14.42 cents a share. So still pretty close, but a little bit less. But just 6 months ago, they were looking for $16.57. So this is a big change, right? So if PNC comes out and they beat earnings by like 30 cents this quarter, well, that's not really a beat, because just 6 months ago we were expecting a lot more earnings to come in, and so they definitely missed those expectations. Now, why this is important, so the question does come down to kind of a philosophical question here. Yes, if you're going what analysts thought one day before earnings or a week before earnings, for this particular earnings report, they beat those expectations, okay? But if you're using earnings as your primary valuation metric, quarter to quarter earnings, knowing what they'll be one day from now, don't really matter that much. The price of the stock doesn't follow short-term earnings, okay? This is kind of like a big myth that is put out by the financial media, and everybody does it, and it's really it kind of brainwashes everybody to some degree, because when it's just assumed, and that's how everything's reported, like, oh, they reported earnings and the stock did this. Well, a lot of times earnings will come and the stock will do something totally crazy, and the media will just make up a different story afterwards. So it's when earnings matter is over the long term. So I could pick the long-term chart of almost any company, and if you take a 20-year period, the stock price will mostly follow earnings over a long time period, especially a very long time period. But they don't necessarily follow earnings at all over short time periods like a quarter or even a year. I've found that starting about sometime, I mean, it can be shorter, but usually you need to get like 3 years into the future before there's really starts to be a tighter correlation between the stock price and the earnings. And then the farther you go into the future, the better you can predict earnings, the better you can predict the stock price, because the correlation between those two becomes stronger over time. So when analysts tell us what they think earnings are going to be next week on an earnings report, or even a couple months, it doesn't really matter. What matters is what are earnings going to do, because the stock market is forward-looking. Even when the stock market is very short-term looking, it's looking like 6, 9 months, 12 months into the future. So what matters is what analysts thought earnings were going to be 1 year and 2 years from now. And to the extent that, because that is what will correlate to the future stock price for an investor, not a trader. So when they're off by a lot, which they have been with PNC, to me, the story here is, if anybody bought this stock based on what the analysts expected 6 months ago, well, let's just go look and see how they've done. Because this is what the important part of this is. Move me here. So what are we at? This is April. Let's go back. We'll shorten this a little bit more so I can see a little bit better. Let's go back to like December. Let's go back to November. This is like the end of October. So right here, analysts were saying, hey, they're going to earn $16.50 a share next year. And you're a stock investor and you look and you say, oh, well, that's a good valuation, blah, 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 blah. Well, I should probably go ahead and buy it. All right, well, even though they beat earnings, the investor just lost 23%. Okay? So, well, why is that? Well, they didn't really beat earnings. They dramatically failed to beat earnings. And the stock price shows that, because this is representative of what they were predicting 6 months ago. All right? So I have a real problem with this labeling, but I could do this on like almost every stock. But since I was writing on this one right after earnings, and I've had a hold on the stock for a while, like neutral, since I sold it, which when I sold it back here, I mean, I'm sure analysts were expecting earnings to be $18 a share or something. Unfortunately, I didn't log what it was. I think I sold it the week after this, so like in between there. And so just think longer term. The earnings that matter now are out here. So now, when the article was published right after earnings, this was 1460, they beat earnings, and now they expect earnings to be 60 cents lower this year than they did the day before earnings were released, right? So it's getting even worse, even though it was a beat. So I guess my lesson here is, don't pay attention to the beats, to the media reporting, and what matters is what happens a year, 2 years, 3 years. Really, that 2 and 3 year mark is what matters. But often you want the trajectory to kind of start building momentum in the direction that you want it to go. So that was my big kind of message, I guess, of this article. Earnings are deteriorating from what they expected. That's why the stock price is down 25% or whatever it's down. All right. So when this happens, if we look back at, let me see if I put this in here. I didn't. So I didn't do a full analysis of this one. Let's what I wanted to do here was show that what I do is that earnings can fluctuate a lot with this stock, even though it's not what I would consider a deep cyclical. Okay, so let's shorten this a little bit. What I want to look at here are the drawdowns, which you've seen me do this before. So the earnings drawdown. So here's the earnings drawdown. They had a flat year basically in 2007, and then in 2008 earnings fell 27%. Okay, that's a significant decline in earnings, but it's not enough to make it like a deep cyclical stock. So that means we can still use earnings to estimate the valuation and everything, as long as we take into declines like this into account that they'll happen. But here's the tricky part about this type of stock. Even though earnings aren't deeply cyclical, the price is deeply cyclical with certain stocks like this, and this is one of them. So if we take the price back in the Great Recession or Great Financial Crisis, so the price was down, this is on a monthly, so it was down at least 80%. Earnings were only down 27%. So you can see here that even though earnings aren't deeply cyclical, the price is deeply cyclical. This can create some good opportunities as long as you pick one that doesn't actually collapse and bounces back. which they have a history of doing, and that's what I look for. So I try to pick stocks that have a history of doing this. So the way I was able to capitalize on this back in 2020 is, look, their earnings actually never declined. They never went down. They did sell BlackRock here. Like, they had a big position in BlackRock, so that gave them a bump. But even if you just drew a kind of straight line and skipped over that year, you would see that they're up during that brief recession. So, but the stock price fluctuated a lot. Even if you assumed that maybe earnings you thought, oh man, this recession's going to suck. Earnings are going to fall like they did in the financial crisis. They're going to fall 27%. The stock price fell, 50%. I think I bought it when it was maybe about 50% off its highs. So, the stock price fluctuates a lot more than the earnings do. And what I do in order to help with this, because what it means is that if you're using earnings to value the stock, it's going to look pretty cheap during a down cycle, okay? Like, it's going to look really cheap. But if you understand the price history, you understand that that's normal for it to look cheap, and that it will probably get a lot cheaper if there is a recession. So I like to use what I call a recession PE factor for this, and I just basically go back and look at where did the stock trade at during previous downturns, what PE did it trade at, and it got all the way down to a 4.87 PE. Now, during the 2020 sell-off, the standard that I used was if it got within 20% of the recession PE during the previous recession, or whenever the low point was. Sometimes you can find lower points that aren't actually in the recession, but in this case it was. So my standard was if it got within 20% of that, then I bought it. If it met all my other criteria, which this one did. So we got down to, I think 6-ish. Yeah. Come on, fast graph. So we got down to 6.65. It was actually probably lower than this, because if you multiply 1.2 times that 4 or whatever, it probably came out to something in the 5s to maybe 6. This is on April 3rd, so market bottom a week before. So that's what ultimately triggered my buy, and why I bought it near the what ended up being the bottom, instead of at some point at a higher price, even though it looked pretty cheap. Okay, this is a lot of gibberish, but it's kind of important. So the standard that I'm using now is I've decided to use just the straight up recession PE again, but I decided to go with this 6.65 during the current downturn, unless things actually get worse. So we've had this mini banking tremor. If that turns into a bigger, wider banking problem, then I will probably change this and go back to the Great Recession and just peg in on that 4.87 PE before I buy it. But right now I'm using this PE as my guide, and if it hits that PE and things aren't falling apart in the banking world altogether, that's when I'll probably buy. So right now it's at 9, so it still has a ways to go. I mean, to get down there, maybe 20 or 30, 25%, give or take. And that's what I was trying to share in this article, is this technique. So just to be clear, this works the best with stocks that have moderate earnings cyclicality. So that's what this 27% would be decline. And deep price cyclicality, which would mean that the price usually falls more than 50%. And we definitely have that in this case. And I think maybe it's fallen that much this cycle already. I'm not sure. Almost. So those are the two things that you want to look for. And then I use the recession PE with other stocks too. These are the ones, though, that it's really important to use it, because you'll do okay if you buy, and that's kind of the next thing that I point out in the article, is the recovery time. So if you buy PNC here and it recovers in like 5 years, you'll do okay. You'll get good returns. But so if you did that back in 2008, you would have gotten 116% return after 6.5 years. All right, that's not bad, right? That's okay. But if you would have just bought the S&P 500 at the same time, you would have gotten 150% return. So you can kind of see you really you don't want to buy these too soon if you're really trying to maximize your returns. There's never any guarantee they're going to fall deep enough to buy, but that's the same with every stock. When I buy it, I want to have a good possibility to outperform the market. And so that's why when I bought this during 2020, even though I bought it at the market bottom, literally the market bottom, I was able to get 176% when the market only returned 100% in a couple of years. So that's the difference between waiting for that recession PE metric to hit and not. Sure, you could have bought it sooner and you would have done just fine, but you might not have really done much better than the market. And so because it has a history of falling deeper than people would expect necessarily, you can take advantage of that and just wait, be a little more patient and wait a little longer, and it'll give you a better chance to outperform the S&P 500. And then that patience costs you a little bit. You'll miss some opportunities, but as long as you get enough, you can do really, when you outperform by that much, that means you can have a little extra cash that didn't get invested and you're still going to do really good. And then you're actually going to be doing good with less risk, because who knows, there's always something worse that can happen, and send prices lower. So just some things to think about with this. And now I have standard articles written on it on PNC where you can go and just look at my normal valuation process. I didn't do that in this article because that's what I did in my last 2 articles. I mostly just wanted to point out these handful of things, that they didn't really beat earnings, and that I like to use the recession PE factor. And I think my buy price for this was a little under $100 right now. So, but earnings expectations came down since I wrote this article, so it's probably a little bit lower than this now. And if those expectations keep deteriorating, it'll get a little bit lower. And that's kind of where I'm leaning right now with PNC. I'll have a link to the article if you'd like to actually read it without me just skipping all over the place and jabbering on, in the video description. And if you want access to all this stuff, chat with me and everything like that, the Cyclical Investors Club membership is $30 a month. I'll have a link for that down there too. If you just want to go to Seeking Alpha, I have a lot of free articles on there if you want to check those out. And you can also subscribe to the YouTube channel, which I'm committed to putting out more videos than I have in the past here. All right, thanks for watching, and I'll see you guys later.